So a couple months ago, I sold a rental property with a net profit of $70,000, and I bought this property 5 years ago with only $2,500 down, which is a smoking hot deal that I did. And so in this video, I'm going to show you how I even found the deal, what strategies I've used, how did I structure it in a way that I was able to walk away with $70,000 profit with only $2,500 invested in the first place. So that being said, for those who are brand new coming back to our channel or our profile, what's going on, guys? My name is Sam Kwok, one half of the Kwok Brothers. I'm a real estate investor, a serial entrepreneur, and our channel and the profile is dedicated to helping you do your first real estate deal. And I'll share my strategies, the transformations I've undergone the last almost a decade now being in this industry, and I'll share everything I've done and share them along the way, my journey. So that being said, let's go right into the topic of today's video, which is a case study of a property, a deal that I did. I bought this back in 2017 for $90,000, did $2,500 down, and then 5 years later, which is last year, I've profited $70,000 by selling it for a cash buyer, which is amazing. So let's go back to the original kind of starting point of how did I even find this deal in the first place? So I'm gonna actually share my whiteboard to kind of illustrate things visually, because I know a lot of you guys like visual learning, right? So let me share my whiteboard. So I originally found this, a couple of things I've did. Number one is I've identified the key markets that are best for rental properties. Now, this is at least my opinion and just kind of my philosophy when it comes to real estate investing, is that I like to go to some of the more blue collar areas, not high income, right? I typically look for mid-range income areas that might be a little bit older, and there's certain demographics that would support that, right? One of the key things you can look for, laundromats, okay? When there's a laundromat, typically it's a rental property type of a market. So that's a little secret that I share. Obviously, I share a lot more. We can unpack a lot more. We do have a real estate investment coaching program, which I'm not going to, I'm not here to necessarily tell you guys about that. But one of the key ways to look for a rental friendly market is a laundromat. So keep an eye on those for that. So I identify a particular town in my area that were better for rentals. Another way you can also look at, or key indicators, is look at the rent to the purchase price ratio. This is called the 1% rule. And the 1% rule is you want to take the purchase price or the going value of the price of the homes in the area, and you times it by 1%, and this should be the minimum rent that you need to be collecting for the math to work, right? For the analysis to work. So I have a separate video dedicated to this, so definitely check it out on how to calculate the cash flow on a rental property. But a 1% rule is a pretty good way, more of a litmus test, I would say, not the rule, but it's kind of a starting point to look at a market and go, okay, yeah, this area is going to be a better rental neighborhood or not. So what you want to do is you want to kind of survey and look at a given area and look at the purchase price, kind of the going purchase price for the area, and look at the rent, the going rent, and if it meets the 1% rule, then you're good to go. That's probably a good area to kind of look into and farm, which is a term I use, to actively look for deals in that area. So that's what I did. I identified an area where I said, yeah, this area is going to be great for rentals. Next, what I did is I did use this software, and it really doesn't matter what type of software you use because they all kind of give you the same data. What I've done is I looked for properties that were non-owner occupied, okay? Which means that it was a landlord that owns the property. So in that geographical area that I'm looking at properties that are non-owner occupied, landlord owned, right? The other thing I looked at is the landlord is also either a corporation or an LLC. Now, an LLC stands for Limited Liability Company. It's a legal entity you can get. And again, I'm not a lawyer, but talk to a lawyer. But typically, the reason why you'll get an LLC is for asset protection, protecting yourself from liability, lawsuits, and so on. Of course, I have an LLC to make sure that I'm protected from potential lawsuits or things that could happen. Right? We're in a game of real estate. I mean, you will get sued at one point. So you want to be, make sure you're protected from those types of things. So I do these things because I'm looking for landlords. And what I found out to be true is that landlords that are an LLC typically, not always, typically own more than one property. So what I wanted to do is I wanted to go find landlords who had multiple properties that obviously they have a higher likelihood of at least selling one of them, right? If a landlord owns 20 rental properties, obviously there's a greater chance that they will at least like to sell one of them as opposed to a landlord who just owns one, right? Because you talk to a landlord who owns one rental property and you ask them, hey, would you be interested in selling the property? They're just going to give you a yes or no, and that's really at the end of the day, right? But if I go and approach someone who's got 20 rental properties, they might say, you know what, I'm not interested in selling that, but I am interested in selling this here, right? So you see what I mean? So the likelihood of you actually finding a deal is much higher because of the sheer volume or the number of rental properties that this landlord has. So that's exactly what I did. Look for landlords that had their property in an LLC or a corporation, typically an LLC. And what I did from there was I went into the my state's Secretary of State website, and I actually looked up the owner information of the LLC. But I also pay attention to is I'm looking for registered agent. Now, typically, and this is a number that I'm going to make up, so it's not statistically true, but 40% of the time, the registered agent for the LLC is an attorney, a lawyer. So guess what we can do once we identify the lawyer's name? We have a lawyer's name. What do we do? Well, now we can Google the lawyer's name and find the lawyer's phone number, email address, fax, address, the whole 9 yards, right? So what I did is I found out who the lawyer is for this particular property, and I emailed the lawyer and asking him, hey, Mr. Lawyer, I see that you represent such and such LLC. Would you be interested, or would your client be interested in potentially selling the property? And a couple of days go by, and what do you know, right? The attorney comes back and says, yes, you know what? My client is actually interested in selling this property. I'll go and set up an introduction. You guys can talk and chat and negotiate through the whole 9 yards. And I'm like, awesome, perfect. So from there, what I did is I went and, of course, done some due diligence as far as, and this is kind of the pre-homework that I did, is I went and looked at the going rent for the area. And I found out that the going rent for this area is about $1,200 a month, okay? Now, remember what I said, the purchase price was $90,000, so it met the 1% rule, actually exceeded the 1% rule, which is perfect, which is what I want. So the going rent was $1,200, and I've done the cash flow analysis to see, okay, what scenarios do I need to see in order for this deal to work, right? Because you want to know the figures and the numbers behind what is a good deal and what is a bad deal, right? Obviously, I want a cash flow, which is, my primary goal. So I've done some pre-work of analyzing the deal. And of course, I have a whole separate video about how to analyze the cash flow. So you guys can go check that video out after this, of course. So I got the gross rent. I'm also doing some other homework as far as what is the property taxes. And this is before I even meet the seller, right? Now that I have kind of the conversation started with the seller, I want to start doing some homework, right? So I'm looking at property taxes. I'm looking at the average insurance cost. I'm looking at crime rate to see if that's something that I have to worry about, right? All those things that I'm looking at as a pre-work to make sure that I go meet the seller prepared to have conversations about purchase price, financing, and so on, okay? So I do all that work, and then from there, what I do is I go actually meet the seller. I look at the property. I'm looking at, obviously, to see the condition of the property, roof lines, foundation, AC, the whole 9 yards, right? I'm looking at all these things to ensure that the property is in a good shape. So, of course, I find out that, the property is in good shape. And the seller, ultimately, I asked the question, hey, how much do you want to sell this for? And the seller says, I want at least $90,000 out of it, okay? And I'm like, okay, all right, let's do some math. So, I actually have this app called Carl's Mortgage Calculator with a K, so Kalculator. RL, Carl's Mortgage Calculator, and I ran some numbers as far as what my payments look like. So when I did the calculation for the NOI, I've determined that my NOI is around $650 a month, which, by the way, is another rule, 50% rule. You want your expenses to be around 50%, plus or minus 5%. So around 50% of your gross rent should be expenses. If it's anywhere near more than that, then you might have some problems and issues, which you might have to raise rents and so on. But I've determined that my NOI is $650, and this is super duper important because you want to make sure that whatever your financing is going to be, or seller financing, your monthly payments have to be less than your NOI. Because let's say your mortgage payment is $750 a month, that means you're losing negative $100 a month in cash flow, right? We don't want that. We don't want to be losing money every month unless it's not on purpose for a strategic reason. Yes, it's possible. But I want to make sure I have a clear understanding of what my NOI, my net operating income is. Basically, it's my income after all the expenses, right? Before the actual mortgage or financing payment. So once I've done that, what I ended up doing is I actually ended up negotiating for seller financing with the seller. Now, for those who don't know what seller financing is, I have a separate video, my ultimate guide on seller financing. You guys can go check that out. But what you do need to know about seller financing simply is instead of going to a bank to get a mortgage or hard money lending, I've negotiated with the seller to where I'm going to go and make monthly payments to the seller. In exchange, the seller gives me ownership right of the property. So in essence, the seller is going to get monthly payments, which includes interest, and also obviously the principal payment, which reduces the balance itself. The seller is essentially getting monthly paychecks without having to worry about tenants, toilets, or termites. None of the management. The seller, all he's getting is just a paycheck every month, which is pretty good. So here's where we ultimately settled at. We settled at $90,000 purchase price. And we decided initially to do $5,000 down. Okay, and I'll show you how I got to $2,500 in just one sec. So $5,000 down. So the remaining balance at $85,000 is going to be paid off in a span of 15 years with 4% interest, which the payment ends up being, by the way, I highly recommend an app called Carl's Mortgage Calculator. It gives you a really good idea. Calculating payments and stuff for financing. I definitely recommend it. So it's Carl's Mortgage Calculator with the K-A-R-L, Carl's Mortgage Calculator. So I got the payment here, and that's about $628.73. So $85,000 balance is what I owe for 15 years, 4% interest, $628.73 is my monthly principal and interest payment. Now, the reason why I went with the shorter amortization is because I wanted I wanted to make sure I was aggressively paying down the financing, the balance, right? And part of it was I had a 5-year balloon. And a balloon payment simply means is that in 5 years, whatever I owe after 5 years of making payments, whatever the balance is going to be, I'm going to make a lump sum payment to the seller. So obviously it's going to go from $85,000 to somewhere around $60-some thousand that I would owe 5 years later. So yeah, 2017 is when I bought it. And then it was 2021 when I actually got a line of credit to pay off the seller. And then 2022 is when I sold this property for literally $70,000 of profit. So again, I'll get to that in just one sec. But first, let's talk about how did I go from $5,000 down to $2,500. Well, what ended up happening is that a couple of days before closing, I asked the seller, hey, do you have the security deposit? Because this property was already a rental, so I would be inheriting a tenant. I asked the seller for a security deposit as well as the first month's rent. And that equated to be about $2,500. So the seller says, you know what? I don't have the security deposit. I don't know what happened to it. And it is typically customary for the seller to give you 1 month's rent as part of a closing credit. So I asked for that, right? I simply asked, like, hey, if you don't have the security deposit, if you don't have the first month's rent, how would you like to just build that into the down payment? So ultimately, what I was able to do is I negotiated for a closing credit to where I can go take the $5,000 down and reduce it down to $2,500. I still owe $85,000, not $87,500. I would still owe $85,000. The difference is the closing credit reduced my cash outlay of $5,000 down to only $2,500, which is awesome, right? It increases my net cash on cash return, which is great, which is phenomenal. That's exactly what I want. Okay, so from there, obviously, tenant makes payments on the rent. I did have to do some repairs along the way, but that's built into my NOI, right? My expenses and future capital improvements. And 5 years later, my $2,500 cash down essentially became $70,000 profit. And what ended up happening was, I think I owed close to about $62,000 owed. And the property sold for $150,000, around there. I have to go back and check the records. But the math on that is fairly simple, right? You take $150,000 minus $62,000. It's around $88,000, but I paid, closing costs and paid, the title fees, paid commissions for the real estate agent, and I've netted around $72,000. So there you go, $72,000 net on a $2,500 down 5 years later, which is pretty good, right? I would say, I believe the return on investment is bonkers. It's crazy. 2,500, yeah, it's like 288 some %,000 probably. But anyway, that's a pretty good deal, right? You put $2,500. How do you do that with the stock, right? You buy a stock worth $2,500, and 5 years later, it's worth $72,000. That's crazy, right? So this is a case study that I like to share not only with my coaching clients and students, but I like to share this with you guys to show you what's possible. This is 2017. So I still believe this is possible even today, where you can find the right deals, find the right type of markets, negotiate for seller financing, put as least amount of down as possible, aggressively pay it down, and then you can later refinance or sell and then get these types of net, or just buy on hold and continue receiving cash flow. But you want to be in a situation where you have a lot of equity and you're in a safe space. So that being said, hope this case study was inspiring. You got some lessons out of this. Maybe this is helping you kind of think differently about how to get your first deal or your next real estate deal. So if you guys want to learn more about different real estate investment strategies or tactics, definitely stick around. We have a ton of more videos about investing, tactics, strategies, blueprinting, all that and more. So check it out, and we'll see you in another video. Take care.